Have you ever stopped to think about how an insurance company actually comes up with your premium? Or how a pension fund can promise, decades from now, that they'll have the money to pay you? Well, it all boils down to managing financial uncertainty. And today, we're going to take a look inside the science that makes it all possible.
So let's kick things off with a pretty big question. What is the price of a promise? When you really think about it, that's exactly what an insurance policy or a pension plan is, right? It's a promise of financial security when the future is, totally uncertain. So how on earth do you put a price tag on that?
The answer? Well, that's where actuaries come in. These are the pros who deal with risk and uncertainty for a living. They're the ones using a ton of math, statistics, and financial theory to peek into the future and figure out the financial impact of, well, pretty much anything that might happen. You can think of them as financial architects, building the models that price those promises and make sure they're solid.
So, how do they actually do all that? You might think it sounds a bit like guesswork, but it's not at all. Actuaries have this really methodical, repeatable framework for tackling uncertainty. It's basically their professional playbook.
And at the core of that playbook is this 5-step process. First, you've got to identify the risks. What could go wrong? Then you measure them. How likely are they to happen, and how bad will it be if they do? From there, it's about controlling those risks, figuring out how to finance the potential costs, and this is key, constantly monitoring everything to see if your original assumptions were on the mark. It's a continuous loop of learning and adapting.
And here it is, the whole process in one diagram. This is the actuarial control cycle. You can see how it works. You specify a problem, develop a solution, and then monitor the results. But look at what's surrounding it all, the wider economic environment. That's super important. And actuaries' work doesn't happen in some theoretical bubble. It's all tied to what's actually happening in the real world.
Okay, so to really see how powerful this cycle is, let's use it to tackle a risk that is definitely on everyone's mind these days. We're going to deconstruct the inflation challenge.
I mean, just look at this list. Actuaries are constantly juggling a ton of different risks. You've got business risk, market risk, credit risk, even cyber risk. Each one of these needs its own super careful analysis. But yeah, there's one on this list that's been making headlines for a while now. Yep, let's zoom right in on that last one. Inflation. It's that sneaky risk that just quietly eats away at the value of our money and can really shake the foundations of every single financial promise out there. So, what is inflation risk from an actuary's point of view? It's the danger that future costs for things like medical care, technology, or building supplies will rise much, much faster than you planned for. This erodes the real value of savings and can make things like insurance claims or pension payouts way more expensive than anyone originally projected.
So how does the financial system even try to control this? Well, when inflation gets too high, central banks step in. Their go-to tool is raising short-term interest rates. What that does is it makes borrowing money more expensive for everyone, businesses and you and me. The goal is to slow down spending across the economy, cooling off what's called demand pull inflation.
But, and this is a big but, it's a really delicate balancing act. Raising interest rates is designed to fight that demand pull inflation we just mentioned, too much money chasing too few goods. But there's another side of this coin, cost push inflation. That happens when the cost to produce things go up. And ironically, if a central bank were to cut rates, it could weaken the country's exchange rate, making imports more expensive and causing this exact problem. It's a constant push and pull, and an actuary's job is to model the potential impact of every one of these scenarios.
All right, so we've looked at the theory and the big economic levers. Now let's bring this all back home. How does this connect to the financial products in your own life?
And this really gets to the heart of it. This work isn't just about crunching numbers, it's about people. It's this incredibly careful balancing act between the needs of customers, shareholders, and the long-term stability of the business itself. And that balancing act directly shapes the financial world that you navigate every single day. The price of your car insurance, the stability of your pension plan, the terms of a life insurance policy, or the income you get from an annuity. All of it is built on a foundation of actuarial science, carefully pricing the promises of today to make sure they can be fulfilled tomorrow. Which leaves us with a final thought. The world of risk is always changing. We've got huge, complex new threats emerging, like climate change and massive cyber risks. The core challenge is still the same, but the variables are getting way more complicated. So the real question for all of us is, in this world of new threats, how do we continue to accurately price and protect the promises that secure our future?